Inflation control sits at the core of macroeconomic governance. It affects savings, investment, employment, and growth. Central banks historically balanced price stability with development goals like credit expansion and public investment. In India, this balance shifted after the 2016 amendment to the Reserve Bank of India Act 1934, which formally adopted flexible inflation targeting with a 4% target and a plus or minus 2% band. The question now is institutional. Has this rule-based monetary framework strengthened credibility or narrowed the RBI's traditional developmental role? The core issue is whether rule-based inflation targeting constrains the central bank's ability to support growth and structural transformation in a developing economy. India adopted the flexible inflation targeting framework following recommendations of the Urjit Patel Committee. The 2016 amendment inserted Section 45ZA in the RBI Act. It mandated the central government, in consultation with RBI, to notify an inflation target once every 5 years. Accordingly, CPI inflation of 4% with a tolerance band of plus or minus 2% was adopted from August 2016. Institutionally, this marked a shift from a multiple indicator approach to a rule-based framework. The Monetary Policy Committee was established under Section 45ZB to operationalize this mandate. The theoretical assumption behind flexible inflation targeting is simple. Stable prices create a predictable environment for investment and growth. High inflation hurts the poor the most. It distorts savings, it reduces real wages, hence price stability is development. But theory assumes inflation is primarily demand driven. In India, inflation is often supply driven. Food inflation contributes nearly 45% to CPI volatility. Monetary tightening does not produce more onions. Yet, under the flexible inflation targeting, RBI must respond even when inflation arises from global crude oil shocks or monsoon failures. This creates a policy contradiction. Between 2020 and 2023, inflation frequently breached the upper tolerance limit due to pandemic-related supply disruptions and geopolitical shocks. RBI maintained accommodative policy to support growth, invoking flexibility within flexible inflation targeting. This shows FIT, that is flexible inflation targeting, is not pure inflation targeting. It is conditional targeting. The developmental role of RBI historically included priority sector lending norms, directed credit, refinancing institutions like NABARD, and liquidity support to MSMEs. Critics argue that strict inflation targeting reduces policy space for such interventions by prioritizing inflation over employment and output stabilization. However, empirical evidence suggests otherwise. Post 2016, inflation expectations became more anchored. Long-term bond yields stabilized. India avoided hyperinflation episodes seen in 1990s. Macroeconomic stability improved India's sovereign ratings outlook and investment climate. Moreover, RBI has continued developmental interventions even under flexible inflation targeting. During COVID-19, it deployed target long-term repo operations, moratoriums, and emergency credit line guarantee schemes in coordination with the government. This indicates a shift from discretionary activism to structured flexibility. Flexible inflation targeting has changed the method, not the mandate. The real tension lies not between inflation targeting and development, but between monetary policy and structural bottlenecks. Inflation caused by logistics failures or agricultural supply chains cannot be solved by interest rate adjustments. Blaming flexible inflation targeting for developmental constraints misdiagnoses the problem. Going forward, coordination between fiscal policy and monetary policy becomes essential. Supply side reforms, food buffer management, and energy diversification must complement flexible inflation targeting. Periodic review of the inflation basket and improved core inflation targeting may enhance responsiveness. Developmental central banking in the 21st century must operate within credible macroeconomic rules. Flexible inflation targeting, when flexibly applied, need not be a cage. It can be a compass.